Hello, everyone, and good afternoon. Thank you for joining today's webinar. We're reviewing the first half of 2024 and looking ahead at what may come in the second half of the year. Please note for this webinar today, all participant lines are going to be muted during the presentation. You are welcome to submit written questions during the presentation. To do so, use the Q&A box located at the bottom of your screen. We're going to collect all questions and answer them at the end of the presentation. We're also recording this webinar today and the presentation slides, and we will make this available to you next week. So without further ado, I'll turn this over to Chad Staskal, Managing Partner of Eagle Wealth Management.
Well, thank you, Wendy. Good afternoon, everyone. I'm so excited to be here and hosting this exciting mid-year update for 2024. As many of you know, we are a fiduciary firm, and what we do is we help our clients with their entire financial well-being. We're committed to the rule that our clients' best interest comes first. As a family-run independent firm, we're able to be selective of the firms and offerings we present to our clients. This allows us to align each client's goals and values with their investments and financial solutions, while removing many of the conflicts of interest so commonly found in our industry. One of the firms we utilize for economic insight and partner with as a fiduciary investment manager for some of you is City National Rochdale. With over 35 years of experience, City National Rochdale specializes in intelligently personalized portfolio management for high net worth families and foundations. Their deep knowledge of investments helps them with managing over $63 billion in assets. They customize each portfolio to the exact needs of every client. And from City National Rochdale, I'm super excited to hear from two of City National Rochdale's leadership team. I'd like to welcome Charles Luke, City National Rochdale's Chief Investment Officer. Charles works on the City National Rochdale's investment platform and wealth management solutions. He joined them in 2018 and brings over 20 years of experience to the investment management industry. Charles led the taxable fixed income investment team and serves as a voting member of the investment committee, crafting the firm's macroeconomic outlook and global asset allocation recommendations. We're also happy to have Robert Meckstroth with us again today. Many of you also know Robert from our prior webinars or in some of our meetings. Robert's a senior portfolio manager for City National Rochdale and is responsible for the investment strategy implementation and monitoring of some of our private client portfolios. I'm excited today to be focusing on current driving forces of the economy, including an outlook on inflation, the 2024 election, and geopolitical volatility. We'll revisit what happened so far in 24, and we'll just try and take a peek at what we're expecting here in the second half of the year. So with that, Robert, I'm going to pass the mic over to you. Thanks for being here and look forward to hearing what you have to say today.
Thanks so much, Chad. And thanks everyone for taking some time out of your day to join us live on the webinar. This is being recorded on July 17th, Wednesday, if you're listening in on the recording. As Wendy mentioned, at any time during this call, feel free to hit the Q&A button to ask any questions. Charles and I should have time to answer any and all questions before we're said and done today. But to dive right in, I've pulled up our speedometers page for July 2024. Longtime CNR clients will know this page. If this is new to you, this is our 20 economic indicators that is forward-looking 6 to 9 months. What you'll see on this dashboard is a combination of colors, green, yellow, red, green being positive, yellow neutral, red being negative. At the moment, just 2 negative indicators, but those are important ones. First off, equity market valuation is a big one right now. In some ways, that's a good news indicator in that the stock market has done so well this year. It's pushed stocks into somewhat overvalued territory. It just means that the price of stocks has gone up faster than companies have grown their earnings, at least for now. We'll get into corporate earnings in a second. You can see corporate profit growth is actually a strong positive indicator on this page. It's one of the nice things going with the economy right now is very strong corporate earnings. The other red indicator, I think, speaks for itself, the geopolitical risk. You can group in the geopolitical risk and the political environment. And I think we've seen it firsthand over the last couple of weeks that there is quite a bit of volatility that can pop up. Like even today, just some comments from Trump at the Republican National Convention, has caused the NASDAQ to drop 3% today, July 17th, at the same time where the Dow Jones is actually up on the day. Kind of a rare market day when you have such big deviations across sectors. But all that said, the underlying trends in the US economy are cautiously positive. If you look at the labor market right now, we'll talk about some slowdown in the labor market, which is important for lower interest rates ahead. But with that said, the labor market here in the US is pretty solid. The housing market continues to be in good shape. We see almost record high home prices still in many markets throughout the country, and that's despite very high interest rates. So if we do start getting some relief on mortgage rates, which we've seen relatively low mortgage rates in real time compared to where we've been in the last 6 months, as strongly supported housing. And then consumer spending is always the big one, with that being 70% or so of US economic output. Consumers have been surprisingly strong. Even today, there were expectations that we would start to get some bigger drops in retail sales. Hasn't really happened. So the US consumer has been central to the economy continuing to grow. But that said, the most important thing I think going forward, as far as the market and economic outlook, is this balance between interest rates and inflation. And we will get into some about the election, but I think the inflation and interest rate environment is ultimately what is going to drive markets more than anything else in the short term. And we're seeing that in real time. April 2024 has been the only negative month so far for stocks, and that corresponded with one of the worst months for inflation data. Fast forward till today, and we'll get into some of the details on it, we saw very much improved metrics in the months of May and June on inflation pressure coming down. And what has that done to interest rates? Well, it's changed the expectations for what the Fed is going to do this year, which might be one of the most important market movers going forward. We're now pricing in, or at least the market is pricing in, almost a 95% chance of an interest rate cut in September. So that said, let's talk about some of our economic forecasts going forward. We have here on the page forecasts for 2024 and 2025. I'm going to show you first some of the changes we've made to the updates. The headline CPI number and the Fed funds rate number go hand in hand. You see the green rectangle around those numbers, meaning we've changed those from our last update. When you look at the CPI number, the May number came in at 3% versus the year-end number at 3.3%. At the end of the day, that's caused the Fed to change their expectations for rate cuts this year, now expecting 1 to 2 Fed rate cuts in 2024. At least those are our expectations. So that's good news if you're looking at stock and bond expectations. And it's one of the reasons why the stock market has continued to rally, the idea that interest rates are coming down. But if we look at our estimates for GDP growth and corporate profit growth in 24 and 25, these are some solid numbers. The idea of a recessionary environment does not seem like the base case anymore. It seems like soft landing is very much the likely scenario, and that's helped by robust corporate profit growth. So even though we talked about valuations being rich on stocks, the good news is our outlook, and our outlook is not an aggressive outlook compared to consensus, is for double-digit corporate profit growth in 24 and 25. So that's a nice thing to have in the economy, knowing that corporate profits are likely to come in decent. Now, again, interest rate and inflation expectations are going to be the big driver. And it's good timing having Charles join, because I'm going to have him dive right into where we think inflation is going and some of the latest data there. Charles?
Great. Thanks, Robert. And it's nice to be with everybody. I'm sorry I'm a little bit late here, but I think by this point, everybody knows the market's moving like crazy. And we just had our investment strategy committee meeting, kind of debating a couple of different potential outcomes. So thanks for letting me be a couple minutes late. But as Robert was going through our outlook here, I wanted to spend a little bit of a focus on two main areas of the economy. And it's not going to come as any surprise, that's inflation and jobs. And so I think if we back up to the pandemic and think about where the conversation was, the focus on the Fed, it really has everything to do with inflation. And that's been a big contributor to the direction of the economy, how the consumer has behaved, and how the government has reacted. So I like to show this slide just because it just sets everything up, I think, in a good context. And that's, if we go back to where we were in 2022, if you look at headline inflation, we were actually up almost at 12% on PPI. So that's the actual price that it costs producers and companies to make products, and north of 8% on the consumer price index. So we were facing extremely high inflation coming out of the pandemic. And we have been on a longer term downward trend across really any measure that we can find. And then if you look at PCE, which is the personal consumption expenditures data, and the Fed looks at that quite closely, that's actually kind of bottomed out. It's come up a little bit because of services spending, but it's right around that 2 to 2.5% level. So that's a core measure. And I think that's really making the Fed notice some of the alleviating price pressures. And then when we think about core, that's been the conversation so far, really this year, because we saw some accelerations at the beginning of the year in those inflation metrics, especially in services. And then here recently, over the past 3 prints, we've seen it come back to us. And there's a lot of good news there. So if we go to the next slide, we can talk about that. And that's just looking at broad inflation trends by breaking out different components of the index. So goods inflation has definitely been on a positive trend for quite some time now. And then looking through Q1 earnings reports, places like Walmart, Home Depot, they made comments on their calls that they were really not seeing a lot of pressure from a pricing perspective. So goods inflation has been on that downward trend and is likely to stay there. And actually at the top line level, because of energy prices and goods, we actually printed at negative 0.1% just last week. And that's kind of what kicked off this entire market situation. So we're in the green area on goods inflation. Services inflation in the top right side here is what's been a little bit pesky. It's what's been sticky, and especially with respect to housing. And I've got 2 housing measures here on the bottom. But if you look at services, housing's been clipping along somewhere at 0.5 to 0.6% on a monthly basis, which is a pretty hot pace. That's around a 5% pace. And so just recently here in the last print, that came down to about 0.2%. So that was cheered in a big way and solidified a lot of the impression right now on inflation being on this downward glide path. And you can kind of see that with this core CPI less shelter, it has been on that downward trajectory. And then if we look at real-time data, this is down on the right-hand side. So this Zillow rental index, which gives us more of a real-time perspective on what's happening with home prices. That's been declining from a peak in late 2021 down to well below 5%. And a lot of the numbers, especially official numbers, take some time to reflect these trends. But the thinking here is now that that trend has been broken on the housing side in these official numbers, that it's going to continue. So there are a lot of things to be positive about on the inflation front. And then the next slide here, just to bring the point home, we do think that inflation is going to continue to moderate. So our forecast, if you look back at the sheet, is about 2.7 to about 3% at the year-end level. And so we could easily see CPI inflation below 3%. And it looks like PCE, again, that measure that I mentioned that the Fed likes to watch, it looks like that's going to be somewhere around 2.3 to 2.5%. And so what that means, if we go to the next slide here, and taking a look at the labor market, we're also seeing corresponding labor market changes based on what's happening with inflation. So it's loosened substantially. And when we take the aggregate numbers into account, so you can see all 4 of them here, and these are all numbers that we've been focused on since the pandemic. But you look at really non-farm payrolls, so just the broad number and measure of jobs, that's been on a declining trend. And there were just some pretty major revisions to the downside on the number of jobs created in the past 2 months. Although the expectation was basically hit on the nose here with this last payrolls report. We did spike to about a 4.1% level of unemployment, so definitely loosening there. Job openings are coming down significantly. So when you measure the JOLTS data, that's definitely coming down. And then one of the areas on the bottom left side here that we focused in on quite a bit was the jobs per unemployed worker. And so that ratio has fallen from about 2 jobs for every worker down to just above 1. So we're really starting to see that tightening. And then you can see the quits rate and wage growth also coming down substantially. And so the prevailing thinking here is that at this level, the market on the labor side has come back into balance, and any further job losses from here would start eating into the existing pool. So the one thing that the market was tilted towards over the past couple of weeks before we got into this rotation rally last Thursday was that growth was slowing maybe a little bit too fast. Maybe it could overshoot. Maybe the unemployment rate was going to go a little bit too high. But I think what has happened here recently with what we've seen is that prospects for the economy, especially in sectors outside of technology, has improved slightly based on the probability and changes for the election in November and the more certainty we have around that. So I think that's faded a little bit into the background. But the point is on inflation and labor, that's the Fed's mandate. So we are going to see interest rate cuts in September. Most likely, there's about 100% probability of that in the futures market right now. And then we're likely to get one more cut at some point this year, most likely in December, since the Fed meeting is right after the election in November. The other component that I wanted to mention on the next slide is consumer preferences. So the other big kind of, if you had to have the big three, you've got inflation, you've got labor, and then you've got the consumer in terms of retail sales. So yesterday, retail sales were pretty positive. It was good to see the consumer continuing to spend, but we are seeing a change in those preferences. So I like this slide because it's very nuanced and it gets into some detail. But essentially what we're showing here is that higher end consumers in terms of the spending composition are starting to switch from national brands to store-bought brands. So if you look at the right-hand side here, the gray shows the decrease in unit sales from 2023 to 2024 in national brands and the increase in unit sales on the store brand side. So even though consumers continue to spend, measures like retail sales continue to be strong, and again, that is 70% of GDP, so it's powering us through, some of those preferences are changing. So when you take it in the totality and think about growth and think about the Fed's positioning, this is just one more data point that says we're looking at a gradual slowdown here, but likely no recession. And then to get into the Fed specifically, we are just one step closer to a cut. So we were having some conversations on the ISC and a little bit broader than that as well, sort of even talking about July potentially being a live meeting. Now, because of some of the comments that Trump made, I think over this week that were released, I guess he gave that interview at the end of June, but because of some of those comments, we'll see what ends up playing out. I don't think July is going to be a live meeting in terms of an interest rate cut. But again, going to September, I think we have a very high probability of seeing a Fed cut at that September meeting in response to a lot of the data and what's going on. The one caveat to that is what Trump did say is that he did not expect the Fed to go before the election. His preference would be for them to go in November. Again, we don't see politics and what's happening on the Fed front cross over very often, and they shouldn't, and the Fed is independent. But it's anyone's guess in terms of how that filters through to the market. So I will say that a lot of the current Fed commentary, and Powell was on the tape a little bit earlier this week, they haven't confirmed verbally or publicly exactly what meeting they think has the highest probability and when they're likely to go. So I think the market is going for 100% in September. That's what we think, but certainly that could change to November or December. But I do think you're going to see Fed cuts this year. A big reason for that, if you look at the right-hand side of this graph, policy has been very tight. So what we're looking at here is the real 10-year Treasury. So this is the level of the Treasury 10-year quote that you see every day, minus inflation, essentially. And that's gone into territory that we haven't seen since the early 2000s. And so Fed policy is filtering through the economy. It's starting to work. And we're seeing that show up in the growth numbers. Okay, so next slide. This is where things are going to get interesting today. So talking a little bit about this rotation and getting into the market. So I've got this slide up here on global volatility. The first half of the year was all about elections and geopolitical events that were happening abroad. We had Mexico, we had elections in India, and a lot of what happened with the European Parliament, and certainly the kind of speculation we had in France, and then the elections that we had at the end of June. So there was a lot going on there, and that did cause a lot of volatility in the market. So you saw a drop in the Mexican market of about 7%. Before it corrected, and has actually been doing pretty well since then. Something like India did have that subsequent pretty heavy drop, but has recovered. And then bonds have also reacted. And so the reason that we have this chart in here is just to underscore that with the election, at that time with pretty even odds between Biden and Trump, we were likely to see some big volatility as we approach November. But if we think about some of the shift that's happened in the topic of the day and the change in the election probabilities, with Trump now showing about north of a 65% probability in November, and then the increasing chance that you could see a Republican sweep, we're seeing a pretty big stock rotation, and then the broadening out of the equity rally that we've been hoping to see for quite some time. So to give you some stats on that, the equal weight S&P 500 is now outperforming the S&P by well over 3%. So it's 4.9 versus 1.6. And then if we look at the number of advancing stocks to declining stocks, that's also at its highest level since October of last year. So we're definitely having this big broadening. And then you take a look at small caps, which have really been the story. And those have now rallied over the past 5 days north of 11%. And there are a couple of reasons for that. And if you'll remember back to February for existing portfolios, we did make the call to add mid cap in February for a couple of different reasons, and we're seeing some of those come through. So the first was expectation for rate cuts and having a little bit more sensitivity to that part of the market. We also know that most smaller companies have heavy amounts of borrowing in floating rate. It's about 30%. And so seeing those rates come down really helps alleviate a lot of the credit stress that those companies are seeing now with rates somewhere between 9.5 and 10. And then we have the Trump trade spectrum. So a lot of that is hitting healthcare, industrials, and financials. And then tech is a little bit outside of that bubble. So if you look at the S&P 500, tech is about a 20% overweight relative to small caps. So those are a lot of the reasons that we're seeing this rotation kind of occur today. And then you top all of that off with, on the next slide, you can see that when we did our historical homework on the presidential election scenarios, usually presidential election years are pretty positive. So on average, going back to about 1928, we've seen presidential election years rise about 7.5%. And then in year 4 of a presidential election on the right-hand side here, you can see that we've had about 18 years with positive returns and about just 5 years with negative returns. So we're already in a pretty good backdrop. And we had returns in the S&P 500 kind of coming into last Wednesday that were approaching 20% on the year. And so it's definitely been a year that's been much better than expected. So those tailwinds were there. And now we're seeing some of these longer term themes based on valuation and sector rotation and the potential election outcome really come to bear. So if you go to the next slide, one of the trends that we've had on for a very long time, and we're going to continue to have this, and again, a lot of this is based on what we're seeing in the markets, but we will continue to favor the U.S. equity market. And there are a couple of different reasons for that. We think just in terms of the election outcome that we could have on the underlying AI trends, the technology advantage that we have in the U.S. Is much greater than non-U.S. And we're also in a situation where we don't have the geographical considerations around the geopolitical front. And plus, our markets have run for quite some time and continue to do well just on an absolute return basis. But I do have 3 simple conditions for thinking about non-U.S. exposure. And that's something that I've talked about in our national webinars over the past couple of months. But those 3 are growth rates. So what can we expect from non-U.S. economies? Can they have sustainable growth? The second one is currency stability. So just based on trade, based on geopolitical events, are those currencies stable? And can we count on those in conversion back to USD to not hurt us? And then the third is geopolitical calm. And that's obviously one that's difficult and I don't think is going to go down anytime soon. So arguably, many countries that are in non-US have met the first item, so growth rates. So we tended to bottom out globally in growth rates toward the end of last year. And the projections remain very strong, both in emerging markets and in non-US developed, so places like Europe. So right now, the US and non-US are kind of coming together in terms of those growth rates. So as the US falls from the 5% levels that we saw in kind of 2021 and 2022 down to this 2% level, we're starting to see non-US and EM come up to the 2% level. So I do think that those growth rates do look relatively attractive in some of these economies, but they haven't met the second 2 items, and that's currency stability and geopolitical calm. So if you look at areas like the euro this year, especially with the elections we just went through, If you look at what's happened with the yen, a lot of that has not been sustainable for us to make a call. And one of the things that's faded into the background a little bit, but there was a lot of talk about the run up in Japan that happened, but a lot of the numbers there were quoted in yen. So that 30% plus return converted back to USD was sub 10%. So that's something that often gets overlooked, but it's very, very important for us. And the thing that we will consider, and I think this is related to the election outcomes, and if you can go back up one slide, Robert, almost finished with the international. But this is really related to the election outcomes. We have to consider, what could potentially happen under policy. So if you think about the Mexico, Canada, and US trade agreement, an area that's been a bright spot for the past 5 days and has benefited from the rotation and was actually doing quite well before we even got into last week was what's happening in Mexico and Canada. So if you think about trying to have stronger supply chains, really American-made products, and I think he's talked about the Apple factory that was established in Austin, making MacBooks, really kind of bringing that back. I think given the trade agreement, there's going to be a pretty big focus on Canada and Mexico as nearshoring really takes hold. So we're not saying we're going to make those trades now, but that's the type of thinking and the process that we're going through from an asset allocation perspective to make sure that we're not bogging ourselves down just with US only. And so if you go to the next slide, I talked a little bit about market participation with the equal weight S&P and a lot of what we're seeing from a rotation perspective. But this has been happening since October of last year. So there were a lot of naysayers out there on the broadening out. I think we came out in late February or March, talked a little bit about the broadening that we saw there. But once we got into earnings season, it did start to reverse a little bit. But the reason this slide is important is because if you take information technology and communication services in the green, and then compare that to what's in the yellow, if I showed you this chart last year, about everything in the yellow would be in a red box. In fact, when we had this chart last year, that circle was red. But now we had positive performance across a lot of other sectors relative to tech. So we did start to see that broadening. And we think, based on what's happening right now, that if we do get this handoff from tech to other areas of the market, and it looks poised to happen through earnings season here, as it's the first earnings season for the non-Mag 7 names to have positive earnings expectations around 5%, that we could have another leg up in this rally. And then the next component of equity valuation and what we're thinking in terms of how to position here is that the S&P valuation is likely overstated. So a lot of what we're seeing is a rotation that's taking advantage of portions of the market that were undervalued. And so if you look at the 7 tech titans, the average PE there was about 32 times. If you exclude those 7 tech titans from the overall valuation of the market, it was at just 18 times. And then if you look at the equal weight, it was trading at 16.3, and then the broad S&P 500 at 21 times. So by removing those 7 tech titans, just that information technology and communication services sector of that market, you were having much better valuation. And so if you think about strategies like our equity income strategy, small caps, mid caps, they were all trading at much more attractive valuations. And then I think we're seeing a lot of these areas take off with some divergent performance of more than 10% over just 5 days because of these gaps. So we really stayed committed to a little bit of that defensive trade, especially with equity income. And that's starting to finally pay a little bit of dividends so far in 2024. And then on the next slide, Robert, I like to point this out because it is very hard to take a look at valuations and just use it in a vacuum. So a lot of the talk has been around how high S&P valuation has been. But if you try to correlate that to near-term performance, and this is on the left-hand side, so this is just looking at valuations and one-year forward returns, you can see that there's really not a great relationship here. It's just kind of scattered all over the place. But the point that we did want to make, and this is reflected in our capital market assumptions and a lot of the way that we model allocation, is that valuations are very indicative of 10-year forward returns. So on the longer term basis, higher valuations tend to impute lower overall returns, and you'll see a much tighter relationship there. So in the near term, the question about asset allocation and how to position, we get very, very little from valuation, but we do know that over those long time periods, those returns can come down based upon those high valuations. But the caveat that I have to this type of a market is that for the past 15 years or the 15 years pre-pandemic, we were in a very commoditized market. And what I mean by that is that most asset classes move together, and you're really kind of squeaking out as rates dropped that kind of higher and higher level. But now as rates have risen, you have better valuations. You have asset classes that are available to you, and we'll talk about fixed income in just a second. But you have asset classes that are available to you that are going to pay you a higher yield, even thinking about something like cash. And so it's an environment here that I think is very, very good for an asset allocator and very good for positioning portfolios. And you can actually take a lower amount of risk today, and I think get similar type of returns that we've seen as we move forward. And so moving on to some of the defensive sectors, and you've heard us make a lot of comments around equity income and value stocks over the past few years, but they have been under historical pressure. So as I've mentioned so far, we are finally starting to see this snapback. So if you think about our core equity strategy and the equity income strategy that we run, equity income has outperformed core just in the past 5 days by about 3.6%. And in particular, when you look at our weightings, our largest overweight relative to the S&P 500 in equity income is in the financial sector. And that is up almost 5% over the past 5 days. So we're really starting to see that rotation take flight. The only caveat that I have to this right now, and it's the one thing that I can pick out as really not being a tailwind in the market right now, and that's the deficit and some of the resulting things that could happen because of what's on Trump's current platform. And so if we cut taxes after the election in November, if the TCJA passes, and if we create tariffs, there could be some pressure on interest rates. And that could put income-oriented sectors and value sectors in a little bit of a bind, even though we're seeing this rotation kind of starting off right now, and we think it could potentially have legs. But that's something that we're focused on. But again, this long-term separation and the historical pressure that we've seen on these defensive income sectors is finally starting to lift a little bit. So if I bring that all together and think about where we are, I think the best way to put it is that short-term volatility is very normal. So to have some swings that we've seen, to have these divergences, again, it makes it a little bit easier from a tactical shift perspective to try to pick out some of these spots. But it is going to be very volatile. So staying focused on the long term, we're going to see these swings. And I'll also make the comment that we still have a long way to go before we get to November. So just like we've seen a very recent turn here just in the past week, and really starting with the debates at the end of June, we could see something else happen that could shift it in the other direction. So we need to be cognizant that the market ultimately is going to zero in on fundamentals, and we need to stay focused on quality in our stock picks, which we are. And I think we're going to see a lot of that through earnings season this year in terms of confirming a lot of our fundamental and quality picks. But we should expect some volatility, even though the certainty around the elections has increased a little bit. So shifting to the bond market and walking through a little bit about what's happened so far this year, we continue to have a lot of rate volatility. So the good news is that we do believe the highs are in around 5%. And we think we're trading in this range, if you go back to our forecast slide, somewhere between 4.1 and 4.6% on the 10-year Treasury. But going back to October of last year, you can see that peak on the left-hand side here at 4.99%, all the way dropping down to the beginning of 2024 at 3.80, and then sitting somewhere between the midpoint there at 4.2% today. So it's been very volatile. And because of that, fixed income returns have moved a little bit all over the place. So if we're looking at higher quality bonds in that investment grade side, that interest rate sensitivity has been a little bit of a headwind, but we're still seeing interest rates north of 5% for very high quality corporate bonds. And then an opportunistic income, and we'll go through these levels in a little bit, but seeing rates that are approaching around 8%. So there's still some very good opportunities that we think can set you up for the next 5 to 10 years, but we're just going to have to deal with a little bit of this volatility in the near term. So on the right-hand side here, you can see asset class returns and yields. So on investment grade munis, again, this isn't tax adjusted, but at 3.42% in terms of yield. You can look at high yield munis at 4.68. So for any of us that are dealing with high tax states or in a high tax bracket, those look very attractive on an after-tax basis. And then getting into investment grade corporates north of that 5% level that I spoke about, and then almost 8% in high yield. So some very good optionality in the fixed income markets. And then when we move into fund flows, this is an area that gets overlooked a lot and I don't think is discussed nearly enough. But going back to basic supply and demand in markets, a lot of what drives things is just how many people are buying and how many people are selling. So if we go back to the pre-pandemic period in 2019, 2020, 2021, where rates were dropping dramatically, we had a lot of inflows into the bond market and performance was pretty strong. That was until we hit the inflation snag in 2022, where we had one of the largest years of outflows in fixed income on record, but that's finally started to reverse. So when we're thinking about how we're projecting interest rates and the potential returns that could be available to us in the bond market, the fact that that has shifted is a very positive tailwind for us going forward. And then the other component that's very important about the market on the next slide, and this even filters back to our equity outlook and the basis for some of the earnings projections, but it's that corporate balance sheets remain very healthy. And so when we talk about high yield corporates and some of the names that take a little bit more risk, we talk about default rates. So how many of those names are defaulting on their outstanding public bonds? And you can see that on the left-hand side, after the pandemic, with the amount of fiscal support and the fact that the markets were really wide open. So one of my favorite statistics from that whole time is that the bond market in 2021 basically had about $2 trillion of issuance. The next highest year in history was about 1.1 trillion. So you had $900 billion of issuance in fixed income in 2021 above the next highest one. And so what that did was money was freely available. That took default rates very, very low on the corporate balance sheet side. And we're seeing those start to come up a little bit, but they're heavily concentrated. So you have a lot of big names in the index that actually used to be investment grade rated that dropped down below BBB into that BB sector. And those have actually moved back up into investment grade. And so we're seeing a lot of the names that were defaulting there kind of come up just because of how that's calculated. And so we're right around just north of a 2% level on the default rate. And you can see it kind of falling down here a little bit. So we think it's going to stabilize here. And we're not concerned about defaults kind of increasing up to that 4 or 5, even going to that 8% type of level that we've seen in past credit cycles, again, because our recessionary probability is low. And it looks like we have some pretty deep embedded tailwinds here from a growth perspective. And then if you look at yields by rating, you can just kind of see the breakout AAA all the way through to high yield. You know, because of this health and balance sheets, I think the yields that we're getting, a 481 in AAA, all the way out to BBB, and then a high yield at 8%. Again, you don't have to take a lot of risk to get high levels of yield. So we can position portfolios in the fixed income side with those lower levels of risk as we move forward for some pretty attractive yield levels. And then just to end and wrap it up, to hit some of these levels, again, looking at cash on the 6-month treasury side and fixed income, pricing at about 5.3%, looking through to investment grade municipals, taking that 342 level and tax adjusting that, sort of showing that after-tax return around 578, same thing in high yield munis, and then very attractive yields on the investment grade corporate side and in high yield corporates. And to kind of wrap up my comments for today, and then I'd love to hear some questions from you, but just kind of going through some of our strategy insights. So when we're thinking about core equity, we're really looking for that fundamental driver shift and that broadening that we've been talking about and that we're starting to see in the market because of the sector rotation. And then a big tailwind there that we do see for the entire market is Fed easing. And so our projections for that to occur in September and then potentially to get an additional decrease in December bodes well for how the equity market could behave. And then if you look at equity income, the valuations, what we talked about, they still continue to look great. And so that's going to be a fundamental driver of any potential shift into equity income. And the threat of immediate higher rates is diminished. We still have that uncertainty around what the budget could potentially look like under a Trump win. But in terms of where we are in the near term, locked into this 4.1 and 4.6% range. So that should be a much lower factor and much lower pressure on the equity income strategy as we move forward. And then we're benefiting from more defensive sector exposure. So again, the financial sector, the healthcare sector, and other industrials, to us, we think can continue to drive performance there. And then on core fixed income, it's all about the attractive yield levels. Seeing north of 5% here We think that clients can take some duration risk, just given that we think we're locked in at these levels for kind of the mid to intermediate term. And that's going to help get the yield level up in your portfolio and then prevent any cash yield from coming out of the portfolio when the Fed does cut interest rates, because those cash levels will come down when they do that. And then on the op income side, when we're thinking about high yield, there really has been some nice tailwinds there. Corporate credit quality is very high, and yields, again, approaching that 8% level. And in some parts of the market and areas that we offer even higher than that, we think that's going to continue to run, and we're going to get paid very well for being positioned there. So Robert, I'm going to stop there, and I can hand it back to you, and I can take any questions from the field.
Well, I'll jump in here. Hey, Charles, thanks for spending the time with us. It's always a lot of good information. We do have a couple of questions, but I'm going to let everybody know at the very bottom of your screen, you do have a Q&A, and feel free to write some questions in there if that would be helpful. Otherwise, I know we did get some questions prior. Charles, one of the questions I had is, and I don't know if we really went too deep into it, was kind of more with precious metals, gold, silver, commodities. What's the views on that short and long term?
Yeah, so what's really coming into view on the commodity side is if we do get a Trump win, and interest rates are coming down and the budget deficit continues to climb, that you're going to have a diversification across central bank reserve currencies. And you're starting to see that with the formation of the BRICS. Some of what we saw, there was a kind of a little bit of a rumor out there around the petrodollar in Saudi Arabia. There's some nuances to that. But we're kind of hearing this drumbeat that the US dollar supremacy might be challenged over the next few decades. And so that, again, combined with lower interest rates here and higher deficits, is sort of providing this, where do we go, right? Where is the safety? And how do we preserve purchasing power? And so I think commodities are getting a lift from that. And that should continue here in the near term. For us on the commodity side, it can be so double-sided, and things can turn on a dime, that right now we're not considering that as a position in portfolios, but it's always something that we're watching. And if we felt like those trends were going to be more permanent, then we would certainly take a look at adding to portfolios.
Another question kind of coming up with real estate mortgage rates. You mentioned you guys have taken quite a bit into financials. Is real estate another area? Obviously, that was one of the major underperformers here over this most recent time frame.
Yeah, so from a real estate perspective, you still have the CRE overhang. And so if you look at regional bank earnings especially, that's the core focus. And a lot of that market has been able to escape pain because they've been able to extend some of those deals. And so what's going to save that market is if interest rates come down. So it's really going to benefit. Our contention is that I just don't know how far they're going to fall, Chad, right? So if you go from 5.25 to 5.5, you get 2 cuts. Maybe you're at 3.25 to 3.5 at the end of next year. I don't think that's the kind of relief that those markets are looking for. So we're still very cautious on real estate overall, although there should be some relief just based on slightly lower interest rates.
Good. And so I'm just kind of looking to see if there's any more questions coming in. Yeah, I think that kind of is all the questions we had going on that. And I guess the one kind of came up as well is you mentioned alternatives. Is there consideration, or obviously knowing with City National Rochdale, you guys focus especially, I kind of almost put it as almost like more pension management with a lot of the conversation with Bitcoin and the cryptocurrencies. Any education you want to share on that?
Sure. And we're looking at that pretty closely, with the Trump win. And I feel like I just sound like a broken record on that, but it seems like the probabilities there have changed so substantially that it's hard to ignore. But has been broadly supportive of cryptocurrency. I think the quote about 3 to 5 months ago was that he was going to build a crypto army. And so he's been very positive to digital currencies, and I think definitely wants to remain a leader in the US. Whereas, Biden's administration has kind of gone the other way on it. And then you combine that with the ETF creation and the regulatory environment that allowed those to grow very quickly. So you're looking at about $30 billion in crypto ETFs with a rubber stamp from the SEC. So if we're talking about widespread market adoption and stability, I think you can definitely make the argument that we're getting very close to that. And then the positive trends we're seeing from a Trump administration, could make that more of an embedded asset class as we think about the next decade. So for us, again, I wouldn't expect it to be, on the menu here anytime soon. But we're watching it very closely and trying to look for those trends. And I do think that it will definitely be a consideration in the next 3 to 5 years for us.
Yeah, and the only thing I'll add to the cryptocurrency conversation that I hear in the field with clients is the idea of owning cryptocurrency. It's important to note it has not been proven to be a hedge against inflation. So that's something that's very clear. As I hear this, I should own Bitcoin because I'm worried about inflation, or I should own Bitcoin because I want to protect my portfolio. But one thing we've learned about cryptocurrency and multiple years of viewing it is that what happened to crypto when inflation was ripping higher in 2022? Had a very poor year. What happened to crypto when markets have corrected both in 2020 and 2022? Crypto crashed pretty hard. So it is certainly a risk asset. So adding crypto to a portfolio, we think of it as a very high risk, somewhat speculative asset. But Charles makes a great case as to some of the positives that could potentially boost it higher. So I think when we think of it as an asset class, we think of it as an alternative investment that carries a very high degree of risk as far as our analysis of the space.
Good. And I guess, I think probably Robert, I'm assuming most of the questions, I know in our meetings, a lot of them are coming around the elections obviously coming up. And as Charles alluded to many times, it's definitely changing. It seems daily, if not weekly there with all the news. Has there been many changes to your guys' portfolio makeup depending on that? Or are you guys kind of feeling like, regardless of the results, you're happy where you're at?
Yeah, and so if you look at our portfolio positioning and the recommendations, right, we have maintained our exposures in a pretty big way to equity income, right? So that's been a part of our portfolio. And then our core portfolio on the equity side has been relatively defensively positioned. So we still have that defensive tilt. And then we did add mid caps in February. So if you look at the overall asset allocation and the recommendations that we've made in the near term, this type of rotation benefits those portfolios quite substantially. It doesn't pick up the full spread of an 11% jump in something like small caps relative to the S&P 500, but it is very beneficial alongside of the equal weight move. So we're pretty happy with our positioning and that we stuck with some of what we had here. But when any market's moving like this, it can create a lot of excitement and a lot of opportunities for tactical positioning. So I'm excited to see what happens now between now and the election, and to see if we can make any additional moves that would be beneficial. But right now, we feel like we're in pretty good shape.
Robert, any major questions that you're getting quite a bit that you would want to share? I know we're on a lot of meetings together.
Yeah, I think I'll pose a question to Charles on the inflation stuff, because outside of the political environment, that's probably where I get most of the questions. And the one that I think hits with so many clients is the idea of, food inflation versus inflation on everything else. So, I know you hit on goods inflation, and that goods inflation is effectively not existing right now. Service inflation, mostly housing. But what are we seeing in specifically, like inflation in food, food at home and food away from home, because that seems to be really something that's a thorn in the side of many of our clients complaining about grocery store prices these days.
Sure, yeah, and it's a great question, Robert. I'd say where we're seeing most of the pressure now is coming from restaurants, so food away from home. If you actually look at the numbers on CPI for food at home, the trends have been pretty positive, although they've been volatile. So, going back to March of this year, there was about almost a negative 0.1% print month over month in the level of food prices. And then in the last print here in June, it was negative 0.1% overall. So the level of food kind of, I think, has probably peaked. And I mentioned earlier that in a lot of the first quarter earnings calls that we heard a lot from places like Walmart and Target, that they weren't seeing any inflationary pressure in the prices that were coming through in terms of how they were stocking their shelves. So I think we're in a little bit of a better situation, but that speaks only to the relative change month over month. That still means that food prices have jumped over 40% since the end of the pandemic. right? And so wages have kept some pace with that, but it still is putting a lot of pressure on households. And so again, it'll be good to not see that move higher on a month-over-month basis, but it's still something that if we can't get wages moving higher, and if the labor market tips over a little bit more, that's going to be a problem.
Final question I'll pose to Charles, because I've been getting this one a lot too, and we didn't have the slide in this deck on it. Talk about how, even though consumer credit card debt raw numbers are as high as they are we worried about consumer defaults as the labor market loosens up?
Mm-hmm. Yeah, we've recently here just gotten 2Q earnings reports out of several big diversified banks. And there was some slight move up in those loan loss reserves, but most of the comments around consumer delinquencies were pretty positive. And so I think the recurring trend in what we're seeing is a lot of the default increases are happening with the new loans that occurred in 2021 and 2022 for a lot of those transfer payments that came from the government to lower income households, whereas they're feeling pressure now at these current levels of interest rates to be able to pay those off. But if you look in upper cohorts outside of that group, those still remain very strong, and those are not generating delinquencies. So again, it's really focused in some of those near-term vintages, 2021, 2022, and we're not seeing anything at the top level that indicates that's going to be a major concern in the next year.
I got one more. I think is a good one to end up, because we're on the West Coast here and obviously getting hit by a lot of different things with fires and so forth. And so kind of one last question is with the portfolio management and everything, how are you guys dealing with climate change and a lot of the different, it seems more extreme situations happening across the country?
Sure. Yeah. And I mean, I'd approach it from a purely investment standpoint. So, we do have an alternative on the platform that is in reinsurance. And what we've seen, and I think we've all felt this, insurance premiums have jumped substantially. So we're trying to figure out ways to help our clients make money because of that jump. But we do see more risk. So I'm actually in Houston. It's where my family lives. So just in the past month, we've gone through a major it was just a 20-minute storm, but it was hugely devastating. And then we just went through Hurricane Beryl. And so in terms of investments, I mean, we're going to stay focused. It's going to be an element of what we think about in terms of positioning, but focusing on fundamentals, focusing on good products, and sort of trying to cut through some of that noise, I think is the most important thing to avoid a lot of that risk. And so if you think about renewable energy and climate-focused companies, those are still very cuspy, so they're still very volatile. And it would take a lot for us to jump into that market at this point.
Well, I really appreciate your time, Charles. I really appreciate your time, Robert. Thank you for kind of coming on, joining us, sharing the inside of City National Rochdale. Quite a few clients and so forth and people on this webinar. If you have questions, feel free to reach out to us, talk to your financial planner, or just reach out if you have some questions just to our info@myeaglewealth.com. As a reminder, we recorded this webinar. It will be available next week on our website. And thank you for all joining and watching. And Robert, Charles, stay safe. And yeah, definitely hope no more stuff happens down there in Houston. You guys have had more than your fair share.
Thanks a lot, Chad. I appreciate that. It's great to be with you.
Thank you, Chad. Right. Thanks, everybody.
Take care, guys.
Thanks, everyone.